All right. So, second week. Golly, outside of the bookstore and all that other drama, things are off to a good start. My apologies. I mean, it's just kind of the way things work, you know. You all are going to see a lot more of it in your lives than I do. They sort of eliminate certain elements in terms of customer service. Oh, we can just do it online. We can do it. In this case, it's being orchestrated out of New Jersey. And anyway, yeah, there's some price to be paid for the efficiencies or lack of efficiency. I even spoke to the people that said, "Look, can I just skip the whole bookstore issuance?" For those of you who don't know, a number of students bought the e-book, and the wrong version was issued, and they're working through a refund on that. And they're always trying to upsell you. Um, anyway, they kind of got to me at the end there. I'm just losing my patience with them. How they've taken a system that worked just fine and kind of destroyed it. But anyway, that being said, the smart money is buying a used book, on eBay or wherever, and Amazon. I would have gone that route totally, but unfortunately, as I've learned, for some students who are on scholarship or have some sort of program like that, the bookstore, go figure, has got a method where, it has to be purchased through their system. So it precludes instructors from finding a different way. So obviously, when somebody's got a monopoly, there's no need to spend any time taking care of the customer. Anyway, enough of that. So what we're going to talk about tonight is planning financial statements. So some of these statements, don't get too wrapped up. You're not going to have to prepare one and not really even need one for your term paper. But the concepts are valid. I mean, keeping track of how much money you need. And if you do go to get like a home mortgage or something like that, you're going to fill out something that's going to have this information. But they aren't looking to you to hand them one. But if you go through their application process, you'll be essentially generating one from all the materials that are given. So we'll work through some of those concepts and financial statements. So cash flow statement measures a person's cash inflows and outflows. So liquidity is key here. If you remember, liquidity has to do with access to cash. It's great to have a whole lot of money, but specifically like in businesses fail. They may have a great product, they may have tremendous amount of assets, but if they can't meet payroll, if they can't pay the rent, they've got a liquidity problem and they fail and go under. So that's what kills a lot of businesses or people's financial situations. So salaries, interest, dividends, and it could be any source of cash. Outflows are all the expenses. So, recording all your revenues and expenses over time, net cash flows, inflows, minus outflows. So, kind of like a checking account. For most of you, you may use a traditional checking account. Although checking accounts, I think there'll be some sort of equivalent. But the whole notion of writing checks it's pretty archaic. Especially when there's things like Venmo and other stuff. Now, Venmo's kind of got a problem since it's not really monetized. They don't necessarily make money other than trying to get you to get their credit card, but they may transition to something else. But anyway, the whole notion of writing a check and all that old school stuff will probably go away at some point and probably be replaced with some sort of electronic data. The government would certainly love that. The government loves electronic stuff because it's so much easier to track you and keep track. I mean, I'm not conspiratorial here, but if you can get some central digital currency and have electronic transactions, it's really makes it difficult. As I may have mentioned, I lived in Europe for a long time, and everything in Europe, I mean, they've kind of got taxes figured out. I think they're a little bit better than here. Granted, though, we've got a lot of industry that is focused on taxes, and there's a lot of money just generated in preparing taxes. But in Europe, especially like places like France, they're if they charged an income tax, a lot of people wouldn't pay it. They'd spend so much more time and effort trying to collect it, they don't necessarily bother with it, and they found it much more efficient to have a value-added tax, which is sort of like a sales tax, but it's first off, it's not listed separately, and second, it's not just at the retail level. It's every time that product changes hands, there's a value-added tax, and so it's roughly about 20%. So you can see that they are able to generate a lot of tax from that. So when I was in Germany, for example, I'd have a lot of projects done on my home, and anytime a contractor came out, one of their first questions was, and even as an American, they would ask me this. They'd say, "Do you need a receipt?" If you don't need a receipt, it basically means it's going to be done, under the table. The employees will probably still, claim unemployment, and anyway, you're going to get a 20% discount. Your bill will be 20% less. If you need a receipt, well, then it's going to be on the books, and it's just going to be a little bit more expensive for you. So, tax, avoidance is it's not a unique U.S. thing. So, here's a person with a cash flow statement. So, she's got disposable income, after-tax income, interest on deposits, nothing there, just total inflows of $2,500 per month. And then some of the expenses, so sort of a budget here. It's always funny to see all these fairly reasonable costs, and then recreation $600. It's kind of a slush fund. $600 when you're anyway. You might do better by splitting that up a little bit more. Also, as you'll see, one of the things we'll talk about is the notion of maybe putting your investing in as an expense, so that you, in essence, pay yourself first. So that might be a better way to do this, where you set aside maybe 10% of your income. So another entry on this budget would be $250 for investments. And then that money that's left over at the end would actually be more accurate and be money that is unallocated that you could spend. So if you use the alternate method of, I'll invest or save whatever's left over, yeah, you're probably going to find a way where there's nothing left over. So factors affecting cash flow, stage in your career path, yeah. Type of job, yep. Number of income earners. So anyway, things are going to change over time, but that's why a savings program that's based upon a percentage is usually pretty effective, because it changes as your income changes. So, yep. We all know there's different people, and we know sometimes when they're in relationships it can cause a lot of trouble. This is how it used to be, kind of old school, a little bit of income during college, and then you're in your career and you're going to max out, and then you're going to retire. Most people's career path is not nearly this steady. You may have a midlife change. You may, child rearing in here. You may decide, I don't want to do that job anymore. I want to do something I like that pays less. Retirement, maybe I'll continue working. Maybe because I want to continue working because I did well and I chose something I like to do. Or maybe you'll be forced in retirement to continue working. I've got a lot of friends in that thing. They work for the government or whatever, and they've got their head stuck in the trough, and they just can't pull free. They're addicted to that income, and so they'll work till they die. Anyway, not the ideal situation. Creating a budget. Cash flow statement that's based on forecasted cash flow. So useful for anticipating. So everybody's familiar with the concept of a budget. To be honest with you, I don't budget much. I tend, though, to, number one, spend everything on credit cards so I can keep track of stuff. Also for tax deductibility for businesses. It's much easier to get an annual statement. But also, if I'm not going to budget, and I do, see, wow, a lot of money's being spent on different items. Where did it all go? I can go back and look at the credit card statement and have actual data. So anyway, some people find budgets quite useful, and there's all kinds of software now that can be helpful. So it's a little easier than before. But anyway, here's another one. Same Stephanie Spratt. She's got her income. What happened here? So health care, car expenses, other issues coming in there. So she went from having a cash flow to minus 200. Now you could maybe alleviate this by having a sort of an emergency fund. I mean, healthcare, insurance, and expenses. Maybe insurance you can budget for, but actually getting sick without insurance it's you're gonna add a few zeros onto that. Perhaps it's completely unpredictable. But car type things, yeah, especially if you're driving an older one, which I'm not saying an old one, but if you're going to drive something that's economical and not brand new, but even new ones tend to break as well. So anyway, you should have some sort of emergency fund kind of set aside. Certainly you should have your credit card that, like we talked about before, being a convenience user and not carrying a balance on it. At least you can, roll that expense onto your credit card, get the car fixed, and then you've got the basically 30 days in that billing cycle to come up with the cash to pay off that credit card so that you don't end up paying interest on the credit card. So you don't necessarily have to have an emergency fund in your checking account. You don't need that money floating around, subject to identity theft and just you having to look at it each day going, wow, I got that extra money in there. No, it's probably better to have it in a separate account, maybe, with a brokerage or something like that, a financial institution. But in case of emergency, 3 days a week or whatever, you can get the money transferred around and get these issues taken care of or get that credit card paid off. So, yep. So unusual this month's situation. So as long as it's unusual, if you're constantly posting a negative number, you're not living within your means. So something's got to change. And sure, maybe you can work a little harder and do a little bit more overtime. But anyway, you can't borrow. You can't run a deficit continually. So something's got to fix. Yep. So anyway, just because you make a budget, you need to go back and you need to review it at a certain point. Forecasting over several months. And especially, again, not to belabor the thing, and they may do it here stateside, but I know in Europe, your utility bills, you would settle up at the end of the year. And I think part of that was just because their meter reading system was pretty archaic. They'd come around sometimes, like on some of the oil and some of these other things, it was an annual reading. They certainly weren't out there monthly. And so you'd pay an estimated usage each month. And at the end of the year, you'd get utility bills and hopefully it was, in line with your budgeted amount. But anyway, the utility company would set that up. But I remember that each year there was like a reconciliation that would take place. So my point being is, if you're trying to budget, something like heating costs or even recreational expenses, I would think that most people might spend more on recreation expenses in the summer. Perhaps not, though. Maybe you take trips to get out of the state in the winter. So anyway, utility bills will probably be much higher in the winter in Alaska and pretty much nothing in the summer. But each to his own. So here they go. Got those limits. Let me just pause it for just 1 second. All right, so returning to the budget. It's up to you whether you think a budget's going to work for you or not. Obviously, if you're, in a situation where you're running behind or you're just trying to figure it out, you might use a budget. Over time, it just depends. If you are using a budget, you will need to go back and improve it and revise it and, see what's happened. Ethics, stay, whatever. Yeah, if you're constantly borrowing from your friends, well, that probably will take care of itself in a hurry because your friends don't want to loan you money anymore. Creating a budget, more. So now she's extrapolated it over a year. Perfect. And something like Mint might work for you. Let's go and click on that for a second. Take a look. So anyway, keep in mind if you're looking at a thing like Mint and, oh man, this is great because it's a free site. Well, as you've probably heard, if, you are the thing being sold. I mean, if you're getting something for free, then that's probably because your data and your information is probably being sold up. Now, it doesn't mean that that's maybe a reason not to use it. I mean, for some of it, Intuit, the company that owns Mint, they may want to get you on Credit Karma, which is, a subscription service for some of their stuff, or TurboTax. If they get you hooked into TurboTax, and I'm a big fan of TurboTax, it works pretty well. And in fact, even if you do your own taxes or have somebody else do your taxes or whatever, TurboTax is still a great tool for you because you don't pay until you actually file. So if you, have a question about how will something affect my taxes and trying to read the IRS publications especially, it's just daunting. I mean, they're not that user friendly. You can create a profile and run it through TurboTax, and you probably will end up using TurboTax at some point in your life, and it's pretty useful because it, memorizes all your previous year's data, so your name, your social, your address, all your stuff. It's fairly efficient and fairly useful. There's also other programs like TurboTax, other competitors in the market that might be better. And just like, not to belabor the bookstore thing, but just because something's working well for a while doesn't mean that it may not change and, go south at a certain point. Most businesses and things have a life expectancy. So Mint may be pretty good right now, but there may be another, software or online tool that's more useful and better. You just have to constantly monitor any service you're using because companies tend to get stagnant and not deliver the same service they did when they were new and the big thing. So anyway, Mint is something you'll probably want to check out, or one of their competitors. So I'm not shilling for these guys, but it can be kind of useful. Personal balance sheet. So this, we talked a little bit about budgeting, and now we're talking about a balance sheet. So assets and liabilities, right? This is key when you're thinking about buying a home or you're going to make some large purchase. They want to know what your credit worthiness is and what your net worth is. And so your net worth is your assets minus your liabilities. So you have to be honest with this stuff. You'll see people put kind of silly things on here. I had one lady I was working with, and she said, well, your goodwill is worth something, so whatever is my training, PhD and all this stuff, somehow I'm worth $8 million. Well, I'm not going to put that on a balance sheet. That's goofy. I mean, there's no bank is going to loan me based upon my income, but, or other things, clothing or collectibles. Well, stuff is only worth, in terms of a balance sheet, what somebody else is willing to give you for it. Now, if it's cash, obviously $100 is worth $100. But I ran into this a lot, traveling in the Middle East, where I'd have friends, they'd buy these rugs that were worth, $8,000-$10,000. Well, who are you going to sell that rug to? It may be a handmade Persian rug, but if you're selling it secondhand on eBay, you're not going to be getting that kind of money. And again, collectibles, you need to know what it's worth. But certain things that are easy to value or at least have a consistent value, real estate, investments, things like that, those are key factors on a balance sheet. Anyway, specific point in time is what it looks at. Assets, homes, cars, furniture. So again, it's the resale value of it right now. If you got in a bind and had to turn it into cash, what can you sell it for? And some stuff, it's not going to be as much as you would hope. That's why things like real estate, yeah, they are worth and they hold their value. They actually appreciate. Cars, not so much. Furniture, probably not. Not the type of furniture we have in everyday use. So, we'll talk more about investments later on. Bonds and stocks. So, bond is basically a loan from a company. You are loaning them money. And then a stock, you actually own a portion of the company. And they're, go ahead, they give you an equity position. And you own it. So, a little different. We'll talk more about that when we get into investments. Mutual funds. Mutual funds are just typically a more user-friendly method of buying stocks. They can be comprised of all sorts of different investments, but mutual funds are usually groups of stocks that are held under a common umbrella and have a fund manager, and just sort of makes things easier. Not nearly as important as they once were when, before automated brokerages and all that stuff. You can actually buy individual stocks, but you lack the diversification. A mutual fund will generally have many stocks under the umbrella, so if one company happens to go, have some troubles, the other companies will hopefully, take up the slack, and so it's a little less risky. Real estate, yep. Housing, commercial property that's rented to others. So, but also your personal home would be in there as well. So, liabilities, things that you own. So, a universal definition in terms of personal finance is short and long term, and short term is synonymous with current liabilities. Means under a year, and this goes to the IRS as well. If you make some money on an investment, there's a different tax rate whether it's a long-term holding or a short-term holding, and that's defined as 1 year. And most cases, if you hold it less than a year, roughly you'll be taxed at double the rate. What happens is if it's a short-term holding, it will be taxed as just normal income, like earned income, like you got a paycheck. And so let's say you're in a 28 or whatever percent bracket. The brackets change now and then, but anyway, but if it's a long term, typically the rate that it's charged at is down around 15%. So completely different. Net worth, difference between what you own and what you owe. So if you notice some stray noises in the background, my apologies. My dogs are quite noisy sometimes, but they're good dogs, and I do raise dogs. They are part of my business, so there you go. I have to put up with them now and again. You'd think they would have been worn out on such a nice day today, but clearly not. Anyway, creating a personal balance sheet, so it allows you to determine your net worth. We talked about this. Update it periodically to monitor changes in your net worth over time. And here she is. She's got cash. She's got a checking account, savings account, household assets, stocks. Nice. Total investments. So, yeah, not too bad. It's good to see, even with the modest income already with some investments. Credit card balance. Okay, so how do we go wrong here? So, to be carrying a credit card balance, You shouldn't. This should be 0. You can have a balance on your credit card during the billing cycle, but that doesn't necessarily count. I mean, granted, it's a snapshot, but if you're carrying a balance on your credit card, which I believe is what they're indicating here, that's not good. The amount of interest you're paying on that credit card is not going to be matched by the amount that you're earning on your investments. So before you start investing, take care of your credit cards. Changes personal balance sheet. So, yep. Buying a new car. Assets increase, but liabilities increase. So, yeah, the numbers will change over time. It's funny as people go through life, and I've had some jobs that pay very well, and others not so much. And I always kind of end up with the same amount of money in my pocket because as your income goes up, some reason your needs tend to go up, and they probably weren't actually needs; they were probably more wants. But anyway. So here she is. She's a present situation, but considering buying a car. So it's going to be a bit detrimental. Car's going to go up to $20,000. Furniture, $21,000. Total assets, $25,000. Yeah, does she own the car though? That's the thing. You can't necessarily put that in as an asset unless you paid cash for it. If you're just putting on a loan, you increased your liability. So, there's the car loan, $16,000. So, I mean, I guess you could balance it out that way. Me personally, for simplification, and again, I'm not going to be a strict accountant here, but I would skip showing a $20,000 asset that was that car and showing the loan, especially if it's a new car. Now you're fooling yourself. If you spent $20,000 on a car and you drive it off the showroom floor, it's probably. I mean, granted, we're using old school data because you're not buying cars for necessarily 20, and I guess you could. Anyway, car loan was $16,000. You're probably already underwater. It's probably not worth $16,000. That depreciation probably already occurred. Yep, things we can't necessarily control. Yep, lost jobs, lost incomes, lots of things can happen. But that's why, you live within your means. You don't get in over your head so that you have some flexibility. Although if you're weathering the storm right now, you're probably doing pretty well. Things are pretty rough right now, so I wouldn't expect them to get much worse. I'd hope. Relationship between cash flows and wealth. So, yeah. This has to do with supply and demand. You could show the same with like interest rates. When interest rates go down, home prices go up because there's more people who can afford to potentially buy a house. Right now, although interest rates are up, home prices, well, they're actually kind of up, but they're probably not up as much as they would be if interest rates were lower. If interest rates drop, home prices are probably going to go up even higher because there'll be increased demand now that more people can purchase. Wealth is built by using cash flows to invest in assets without increasing liabilities. Anyway, the point is, the little things you do in life and your financial future add up. And if you're able to live within your means and able to buy assets, primarily assets that appreciate, and stay away from depreciating assets. When you're buying a vehicle, that's not really an investment. That's a depreciating asset. when you're buying a home, when you're buying, something that goes up in value. And not all homes. I mean, not that most of you aspire to live in a mobile home or a manufactured home, but those things tend to depreciate, not appreciate like a stick built or I guess there are some manufactured homes that are not, they don't fit the typical mold of a mobile home. They're more, I can't remember, prefab kind of thing. So your cash flows minus your outflows, obviously your wealth's going to go up. Value of your assets minus liabilities is net worth. Liquidity. So again, I mentioned it before, liquid assets and current liabilities. So if they talk about a liquidity ratio, that's what you're doing. You're getting your liquid assets minus your current liabilities. So can you meet your day-to-day bills? If you've got some huge asset, but it's it's a retirement fund, or it's, well, actually you can take a loan against your retirement fund, but primarily what they're talking about is real estate is always cited as is an asset that's not liquid, just because it takes a little bit to get it. Minimum about 6 weeks, typically. Debt level, debt to asset ratio. So, but some of these generalized statistics where they'll say, oh, you shouldn't spend any more than this on your housing, and your debt level should be, no higher than this ratio. It depends on a number of circumstances, and a lot of times, location. If you're, I don't know why you want to do it, but let's say you're living in New York or San Francisco, the amount of money, and you want to own a home or an apartment, yeah, your ratios are going to be completely jacked up because their real estate is so expensive. Savings rate. So savings during the period to disposable income. So anyway, I've never gone into to apply for a loan and been asked these direct questions or been told what ratios. But you'll generally fill out paperwork that gives them indications, and a lot of it too, though, has to do with your credit history and your future earning potential. Your job. So it's not always what you have on hand, but what you have the ability to generate. So this next section, time value concepts. So this chapter is, I don't know, we kind of stole their thunder by using those charts that we talked about initially, looking at the long, running examples of the time value of money. And so all of their examples here are maybe not going to illustrate it as well as the examples that you can pull off of those few spreadsheets that I shared with you. But the value of money is influenced by the time it's received. So again, if you're given $100 today or $100 a year from now, what, should you take? Well, obviously there's, the immediacy, the fact that if you get the $100 today, then you're guaranteed of it. But say you're absolutely guaranteed $100 a year from now as well. What, from a financial perspective, you would still want to take the money now, because you could invest that money and have it make some money. Also, inflation, we've had sometimes where it's negative inflation just generally isn't a thing, and average inflation is about 3%, and now we're in a period of double, triple that. So Obviously, $100 today has got $100 worth of buying power relative to today. But $100 a year from now um, may only buy, $90 of what it could today. So inflation is insidious and it just affects your money. So anyway, time value of money. Earlier you start saving money, the more quickly your money and interest can grow. And we're not talking about simple interest here for the most part. Simple interest would be, I'm going to pay you 10% simple interest. You give me $100 now, and I give you $110 a year from now, based upon your 10% interest. If it's compound interest, not simple interest, it means that you earn interest on your interest. So the way you do that calculation is you would get that 10% and you would divide it by 365, so it's going to be a very small number. But anyway, you're going to apply that number to that principal, which would be the $100, and you're going to apply that every day in those increments. So the first day your principal is $100. On day 2, you're going to have a little bit more than $100 because you're going to have the interest that you earned on day 1. And so you're earning interest on a bit more than $100. And it takes a little bit of time, but as time goes on, that $100, you may have say by the end of the year, maybe $115, $120, and now you're earning interest on that $120 by the end of the year because you're earning interest on the interest that's been accruing. Sometimes there's useful methods, and most of the time you find these, if you've got an issue, it's usually contextually on the internet or whatever you're using, whatever app you're using. They won't necessarily use time value of money, or they may not talk about future values of a dollar, but they'll say more in common English. If I want $1,000, a year from now, how much money per month do I need to start saving to end up with that amount of money, given an interest rate? And so it can get kind of complex. There's some formulas that help you figure it out, but big picture is you don't really need to dive down in those formulas because you're not going to do that. There's going to be an app that's based upon that formula, and it's going to calculate it out. So we're not going to waste a whole lot of time, running equations and make this into a math course, as long as you know where to find that number. And they'll use some different terms that you don't see that often. Annuity just means a series of equal payments, right? So, but annuities can also be used as an insurance vehicle, let's say, or similar to an insurance vehicle, because they're in some ways better than insurance. Insurance pays you, say in terms of life insurance, it pays off if you die. An annuity, if you have an annuity policy issued generally by an insurance company, what you do in that case is, say you have an annuity, and the plan here is you give the company, the insurance company, say $10,000, and they issue you an annuity. And the deal is you give them $10,000 and they start paying you $100 a month for the rest of your natural life. So, if you die tomorrow, you didn't make a good bargain. That didn't work out for you. But if you live another 40 years, you got way more than your $10,000 back. So in that way, it's similar to insurance, but kind of the opposite. This one, that an annuity pays you the longer you live rather than as soon as you die. So, but anyway, annuity is just a general financial term that means this series of equal payments. So it can be applied in a number of different ways. Or so again, let's say the way they're using it in this context is they're looking at, I need a certain amount of money in the future. How much money do I need right now in a lump sum to put together at a certain interest rate to generate that amount of money based upon the interest. So if I have $100 right now and I want, $1,000, a year from now, what sort of interest rate do I need to, be accruing? Actually, that's not a great example because $100 a month would get you over 1,000. But let's say you want $1,500 and you want that in a year, and you're just going to put down $100 a month, which would be only $1,200 in payments, and you want $1,500. So there's a method of finding out the interest rate necessary to get to that amount. Or you could do, okay, I've got $1,000 right now, and I want $1,500 a year, so it's a lump sum. So I'm not a series of payments, just a lump sum. And what interest rate do I need to get that payment? So anyway, sometimes these things are useful. Sometimes it just depends on the application. Compounding, I've hit that a couple times. That's interest on interest, and that's what gets you a high rate of return. Is the fact that it's not simple interest, that it's compound interest, that it's interest on interest. So I'll let you read through. So future value of a single dollar amount. Again, don't get wrapped up with the terminology. Just think of the application, I've got a certain amount right now. How much is it going to be worth 10 years from now at a given interest rate? You use the formula and you'd figure it out. And now they're going to want to introduce a whole bunch of, acronyms and other stuff, and I being the interest rate. It just makes it more complex. It's not that overwhelming, but there's applications that do this for you that are dedicated for your application, especially in the mortgage realm. If you're trying to figure out how much my payments are going to be on a home, for a certain amount. Well, it's embodies one of these problems, one of these, this data. But the more useful thing about the online variant is the online variant, like let's say you go to Bankrate or one of these, companies that provides an app to make these sort of calculations. They will also remind you that not only do you have to pay off the note for the mortgage, but you have to have it insured. So you also have to pay property taxes. So let's say a mortgage, a small mortgage. I've got one on a piece of property. It's about $1,100 a month. Not huge, but the amount billed to me each month is about $1,400 because the real estate taxes are in escrow, as are the insurance, meaning the mortgage company, they would rather have all of the mortgage or all of the interest and taxes paid through their account. Because essentially they own the property and they don't necessarily want to trust you to make the tax payments and keep the insurance up. They'd rather be kind of involved in the process so that if anything happens to their property, it's not auctioned off or something for lack of taxes paid, or doesn't burn down uninsured and they're left in a situation. So anyway, there's things that make some of the online calculators a little bit more useful than just the simple formulas. Future value of a single dollar amount. Yep. $5,000. So anyway, the applications are out there, but again, I think for academic purposes, they try to make this a little bit more difficult because you're probably going to forget, PV equals present value and I equals interest. And I mean, it's not difficult, but it's just overly difficult. And interest year payment, computed future value. Yep. And a lot of times there's like a fudge figure that's pulled out of the chart, so it's not like doing it by hand is more intuitive because you're pulling out a factor off of a table that's kind of magic. Future value, impact of a longer period. So we kind of learned all this, that the effect of interest rates over a longer period is much more dramatic. So here's going to invest $5,000 for 20 years instead of 10 years. Interest rate 4%. Boop. And going to end up almost $11,000. Obviously a higher interest rate, 9%, so over double. Now you're up to $28,000. Huge. There's a thing, there's some good information to just sort of hip pocket rules of thumbs. Like the rule of 72, for example. If you're ever curious how long it would take my money to double at a certain interest rate, you can use the rule of 72. So let's say, I'm getting 10% interest, and so I've got some amount of money. The amount of money doesn't matter, but in this case, let's say you got $5,000. How long till, if I'm getting 10% interest on that, how long will it take for my $5,000 to turn into $10,000? Well, using the rule of 72, all you do is get your interest rate and divide it into 72. In this case, it'd be 7.2. So in 7.2 years, your money will have doubled. Is there any application? Maybe. But anyway, it's just, sort of a useful formula to know. If you ever hear Rule 72, that's what they're talking about. Now here they're trying to show, dramatically how an investment grows over time, and it's all completely accurate. But this is where I think the Excel spreadsheets kind of, do a little bit better. So here the person had $1,000, $1,000, and then they left it 10% rate compounding, and so boom. And what did I say about rule of 72 and 7.2? So they started with 1,000 and looking at about 72. Go figure. Right about there, it hits 2,000. And so the rule of 72 checks out. Power of compounding. Amount savings can grow substantially due to compounding. So even Einstein, that's the story anyway, that he was so impressed by the, considered a wonder of the world. And he knew some pretty amazing things. So if Einstein could be amazed by it, so should you. And it works just the same on your debt. So that credit card that, I'm just going to pay the minimum balance and I'm going to go do something else with my money. No, that is going to crush you over time. Now this is not controversial. But for example, so I've got a brother. Him and I are completely different people, right? And if he had any bit of debt out there, he would race out there and pay it off right now. And we were talking about this, and I've got a couple loans, mortgage loans, that are both less than 3% interest. 2.75 and 2.85, and he said something to me about paying these things off. I'm like, never. I will take them out to the full 30 years. I mean, unless interest rates go down below. But when money is essentially, when you think about interest rates, money essentially right now is being rented out for about 7%, 8%, whatever the mortgage rate is. And mine, I've got some that I'm renting for, 2 point something percent. I am far better off if I have any extra money rather than paying off that debt. I'm better off using that money to invest in someplace else. I mean, hell, I could go to a regular bank and get, 3, 4, 5% interest. So I'd be foolish to pay off that money when I can, with very conservative investments, get a higher return. So now that is completely out the window if it's credit card debt that could be up in the 20%. Yeah, that stuff's toxic. You need to get that taken care of now. But anyway, so that's what this guy, without doing more of a nuanced discussion of what interest rate is it, let's say you can buy a home for a $300,000 home, and let's say you're going to put 10 or 20% down. For simplicity, we'll say you're able to only put down 10%. If you're able to take out a loan and buy property, so you're going to get 10% down, so you're going to put down $30,000 to control a $300,000 asset, and let's say real estate's going up by 3% a year. That means that your real estate, your $300,000 home, is going up by $9,000 a year. How much is it costing you? What real interest rate? Essentially, you are getting a return of $9,000 a year on a $30,000 investment. So we're talking a return on your $30,000 since you're controlling a $300,000. Your interest rate to the good is about 30-some%. Well, not about. We can do the math, but anyway, you're doing quite well, given those situations. Now, there's more variables. There's, is the property going to be set vacant, or property taxes, or are there other charges? But just on a pure interest rate play, you're making money by doing that. But when it goes up to 7% interest, oof, now listen, you're paying 21 grand. Would that be right? Yeah, 21 grand on. It's not, the numbers are still in your favor, but just barely. Discounting. So again, why do they say? Anyway, it's just a different term that's used. Discounting, the process of obtaining a present value. So again, put it in context what you need. Amounts you must invest today to accumulate a certain amount in the future. So this is kind of where I started. But anyway, the present value, future value, however you want to do it. Formulas to figure that out. You're always going to have to know the interest rate. You're going to need to know the money on one end of it, and then the number of years, the period, so the N and the I, and then some dollar, whether it be principal or not. Yeah. So financial calculators, you don't really see those too much anymore. Most things are app driven. Everything keeps coming back to the textbook that I'm a little upset with these guys about. We're not using financial calculators so much anymore. So you'd like to get 50 grand, 5 years by making a single investment today. How much do you need? You know the interest rate, so there's a way to formulate that out. And it comes up to 35 grand. So there's utility in the things, but I just don't see the utility in memorizing formulas. Computed present value payment. Anyway. So just like we had a huge lump sum, now we're going to go back to the series of payments, which again, is an annuity. Future value interest factor. So there's consistency in the terms, and if you're a financial person, if you're working in the mortgage business, you're going to use, you're going to become very familiar with the terms, but you're again not going to be running through these formulas by hand. Person gets a lottery, 150,000 every year. So you see these a lot where they say, "Oh, do you want the lump sum, which is a fair amount of money, or do you want a whole bunch more money later?" And anyway, either way, by definition, they were playing the lottery. A tax on the poor or the stupid or whatever. So they're probably not going to end up with anything at the end, but at least for a while. So they use the term discounting, again, bringing it back. Present value, annuity, or an app. So, which one do you want? Well, you just won the lottery, so probably hire somebody. No. Again, there's a lot more factors to this, but you're going to find that the amounts are probably not too terribly different. The problem they present you with is to kind of take advantage of the psychology of you as the winner. What seems more impressive to you? So if you wait, you get the 805. Future value from savings, from motivation. I never have investments that pay off in such a predictable manner. I mean, even though they say the stock market gets 10% overall, it does tend to go in swings. And crypto, man, far worse. Dips and everything else. Hightown motivates you for savings. But that's really the trouble with investing. It's very hard to invest when the market is down. And it's so easy to invest, to put in more money in there when you see the market's up. But that's a psychological decision, and the problem is it's counter to the financial. Obviously, there is a concept called dollar cost averaging, where people put in a set amount each month, and when the market is down, they end up buying more shares, and when the market's up, they buy fewer shares, so it averages out. That's one investment strategy that quite a few people utilize. The answer to these questions are pretty much as you can. I mean, you need to come up realistically with a budget, establish what your needs and what your wants are. Try to keep those separate, try to live within your means, and then try to buy your wants with money that is essentially left over. And then for the homework. So there's going to be cash flow problems and also some financial problems. Now, how you get the answers to these problems, I don't care whether you use an app or whether you use the formulas, however you want to do it. To reiterate, the homework, though, is not due until we get to the final. So, to the respective test, whether it be the midterm or the final. So you don't have to, stress on that. The fact that you don't have the book right now. Um, we're going to look at an app or a video. Again, the video comments, you're just going to put in, you're going to listen to her.
There are so many budgeting apps out there.
Her take on the budgeting apps. Obviously, most of these videos I pull from YouTube, they're people who are trying to sell you something. Keep in mind that you are a huge commodity to I'll get it back to the proper one, to marketers out there. Your demographic, if you're the typical college student, you are what they are after, because although you don't have a bunch of money at this point in your life, they consider your buying habits, your potential. They're banking on all that. They're thinking that you're still malleable. If they can get you to drink a certain kind of beer or whatever beverage, or use a certain insurance company or a certain financial system like TurboTax or something, they are going to provide all sorts of incentives, because it's money well spent for them, since you're still malleable and you offer them potentially a lifetime worth of customer loyalty that you'll provide to them. Whereas somebody who's more established, and especially like somebody over 50, they may have considerably more money, but to get them to switch from one brand to another is immensely difficult, because they're a Ford guy or a Chevy guy or a Toyota guy or whatever, and they're probably not going to be switching anytime soon. And their consumer buying habits are pretty established. And so from a marketing perspective, it takes more money than it's worth to get them to change. Plus, their lifespan is less than somebody, demographically in their 20s or whatever. So there's a lot of good financial tools out there that are available to you at little or no cost, and maybe they'll exploit your personal information, but they will also probably give you pretty good service, because they want to invest in you, since they want you a customer for life. So you're going to see the brokerage companies, and when you're trying to do your financial plan, you're going to see a lot of pretty positive attention from some of these companies, because they're looking at developing you as a future customer. So anyway, work on the homework as you get your book in, just to keep abreast of it. But again, it'll be turned as a big batch assignment just prior to the exam. We'll do exam review before we actually hit the test. So if you're kind of concerned that this is a lot of information, seems a bit scattered, don't worry. I'll spend some time before you have the exam, and I'll narrow your study down to the point where you'll feel pretty comfortable about the test, I assure you. And that's it. Take care.